So let's begin to wrap this up with just kind of a perspective from the investor side. So we've really kind of been talking about the lenders here as the original lenders, but in reality, the folks, especially in distress, that start buying up loans and distressed debt, are folks that are specializing in distress. And so, what you get to a point in the distress process where the actual owners of the business, the lenders and the soon-to-be equity owners, are not the original providers of capital. They're much more sophisticated investors around distress. And so, the first lien lender appears very secure to get full recovery. And so remember, if it's trading at 90 cents on the dollar, that may actually be a buying opportunity, right? It's trading at 90 cents on the dollar, but they're standing to get full recovery. So that's something that a distressed debt investor would look at. They'd look at this plan, they'd look at the valuation, they'd look at what is potentially going to happen and make a decision about whether this is a buying opportunity. The second lien is much more interesting. Based on our valuation and collateral ranges, the second lien debt stands to get anywhere from 55% at low valuation ranges to 69% at high valuation ranges for both collateral and for the enterprise. And so you're talking about a pretty wide potential recovery spectrum based on just our simple scenarios, all of which, by the way, are better than the current trading price of 50 cents on the dollar, which means on the surface you'd say, hey, the second lien debt, that's a buying opportunity as well, because at the very least they're going to calculate they're going to get 55 cents recovery. However, there are a lot of uncertainties, as we just saw, because the form of recovery for the second liens is going to be largely equity. So there's a lot of uncertainties about whether what the second liens will ultimately recover, because their recoveries are down the road. And such a large portion of their restructuring comes from equity. So recall that the second lien lenders were the only ones comfortable with equity instead of debt, which suggests already that the second lien debt is held by a distressed fund comfortable with equity positions. Traditional secured lenders don't like equity usually. So unsecured notes. How do these guys do? Well, recoveries range from 40 cents on the dollar to 54 cents on the dollar, all significantly higher than the current trading level of 20, which suggests that there was some mispricing around this. Maybe nominally it looks like, oh, these are secured, so unsecured should trade significantly less than this. Well, this is the kind of stuff that distressed investors love, where they kind of pour over the information and realize, oh, wait a minute, these guys are actually severely undersecured. And so these guys are going to get much more recovery than maybe these current trading levels suggest. So it's interesting, just obviously scratching the surface from the distressed debt investor perspective of what the opportunities are, but worth kind of mentioning that that's in reality what's happening as these negotiations are taking place. Okay, so as I mentioned, we just scratched the surface. Investors must be mindful of a variety of other issues that can dramatically alter potential recoveries. And I'll kind of list them as food for thought and things to kind of delve deeper in later on. They're things like corporate structure. So if debt is placed at the operating company level, and you have a holding company with multiple operating companies, for example, if the debt is actually placed at the opco level, it has de facto priority to otherwise comparable debt sitting at the holding company level. So the way that sort of funds flow is from the bottom up, which means that if you place debt where the operating business is, where the assets of the business are, well, you have priority, just structural priority, as it's called, over something that might be sitting in the holding company level. So you might be looking at a company, from the perspective of all debt is equal, now realizing that where the debt sits within the corporate structure also matters. You have to kind of understand that and kind of dig a little deeper to figure out where the debt is sitting. Inter-creditor subordination agreements. So this is another thing that is important to understand. Lenders can and often do strike deals amongst themselves when they loan out money to provide capital to businesses to subordinate one lender vis-a-vis the other with no impact on other creditors. And so you might see when you open up a 10K something that says, senior debt or subordinated debt. These are side deals, usually between two lenders. And these side deals can lead to dramatically different recoveries. So we have to understand any inter-creditor subordination agreements. Another element that alters priorities, maturity of claims. So if we're in an out-of-court scenario, even if you have a lower priority loan but is due now, and the company isn't at a point of total distress where, they're obviously insolvent, they may just pay off that loan. In which case, those lenders get full recovery, while the longer maturity, higher priority claims get partial recovery. Now, of course, there are things that can protect those higher priority claims. They can claw back those payments in a bankruptcy. They could argue that this was something called a fraudulent conveyance, which basically means, hey, if you are already insolvent, you cannot be making, payments to people, to various claims outside of bankruptcy. So if you file for bankruptcy, there's sort of a look back window of a couple of years where you can look back and actually claw back money that the court deems unfairly, transferred. So there's some protections around that, but certainly it's not ironclad. The next point is perfection of security interest. Now, secured creditors, we take it for granted. Once, we say something is secured, it means it's secured. Well, that's not always the case. Secured creditors aren't secured until they go through an onerous process of documentation. And often unsecureds often challenge what's called the claim, the perfection of the security interest. They'll have their lawyers pour through these onerous documents, seeing whether a signature is missing from somewhere, whether the perfection of the security interest was actually done. And you'd be surprised that at the very least, this can hold up the process for the secured lenders, incentivizing them to give some concessions to unsecured creditors, as they're worried that there might be some sort of legal challenges to their security interest. If something that was originally deemed secured, turns out to not be secured, these guys' claims get turned upside down. They now go back to the back of the line, just like everybody else, right? So these kinds of the possibility or the threat by the unsecureds that they're going to be, arguing that these security interests aren't perfected by the secured creditors can be legitimate sometimes. The next thing is sort of a nightmare for secured creditors, and that's a concept which is a bankruptcy concept called equitable subordination. The courts, believe it or not, have ultimately the power to unilaterally equalize all claims under certain circumstances. So even though you thought you have a secured or a priority claim, the courts can unilaterally just say, you know what, it's all the same. We're going to do what's called equitable subordination for a variety of reasons. The court has the power to do this. They don't usually do this, but there is that possibility, and you have to understand when that's possible as an investor, that all of a sudden a claim you thought had priority may not have priority after all. And lastly, there are other various preferences to claims. We talked about them a little bit, like government gets certain preferences, lessors get certain preferences, even critical vendors can get certain preferences along with employees, which means if you thought that there was, say an X amount of value available, and all of a sudden all these guys get priorities over your claim, then you might be in for lower recoveries than you expected. So in summary, restructuring is often guided by potential outcomes in bankruptcies. We saw the reason why an out-of-court restructuring usually will have a plan that takes the contours that it does is because everyone is aware of how things might cook out in bankruptcy, that the bankruptcy is always a possibility for the debtor if there isn't consensus. Valuation plays a critical role in determining recoveries. We saw how valuation potentially changes what recoveries look like, and we know that there's not firm guidance on how to value a business, and there's a lot of room for assumptions, which makes valuation a very murky and potentially a central focal point of conflict during the bankruptcy proceedings. We also learned that being secured nominally isn't the only determinant of priority. Collateral value determines the amount of secured claims. We also learned the preferences for equity versus debt can alter the relative risk of the various stakeholders, even when receiving nominally equal recovery. So if you get $100,000 worth of recovery in the form of equity, that's very different from $100,000 of value in the form of debt. And depending on who you are, what type of investor you are, you may be happier with one over the other. Understanding that, lastly, the restructuring process enables investors to identify market mispricing. So we spent a little bit of time at the end just walking through how, from the investment perspective, analyzing this with an understanding of the priorities in bankruptcy helps you really hone in on potential market mispricing.